$20 billion. Gone in 2 days. One of the fastest collapses of a personal fortune in history. And the man who lost it? You have probably never heard his name. Bill Hwang. His firm was called Archegos. In late March 2021, his hidden bets detonated. More than $100 billion of stock value vanished in a matter of days. Global banks lost around $10 billion between them. One of them, Credit Suisse, never truly recovered. And if you held certain ordinary stocks in your retirement fund that week, you watched them fall by half because of a man and a position you could not see. There is a single trick that let one investor hide a $100 billion bet from every bank he traded with, and one warning sign that all of them ignored to keep his fees. I'll show you both, because the most dangerous risk in a market isn't the one you can see. It's the one nobody is allowed to. Bill Hwang was not a household name, and that was by design. But on Wall Street, he had a pedigree. He was what they call a tiger cub, one of the traders personally mentored by the legendary investor Julian Robertson. Through the 2000s, Hwang ran his own hedge fund, called Tiger Asia, and for a while he was very good at it. He was also, it turned out, willing to break the rules. In 2012, Tiger Asia pleaded guilty to insider trading. Hwang paid tens of millions of dollars in penalties and was effectively barred from managing other people's money. For most people, that is the end of a Wall Street career. For Hwang, it was a reset. He took his own remaining fortune and opened what's called a family office, an investment firm that manages the money of just one family. And here's the crucial part. Because a family office has no outside clients, it faces far less disclosure and oversight than a hedge fund does. It can operate almost completely in the dark. A hedge fund must file public reports listing its largest stock holdings. A family office, in many cases, does not. To the outside world, Archegos barely seemed to exist at all. He named it Archegos, a Greek word meaning leader or prince. Quietly, over just a few years, Hwang turned around $10 billion of his own capital into one of the most powerful hidden forces in the entire market. Devout, soft-spoken, giving generously to religious causes, he looked like a reformed man running a quiet little family fund. The banks lining up to do business with him knew his history. They lined up anyway. The fees were simply too good to pass up. Here is what those banks could not see or chose not to. Hwang was not spreading his money across hundreds of stocks. He was making enormous, concentrated bets on a tiny handful of companies, names like Viacom CBS and Discovery. And he was not just betting his 10 or 20 billion. Through borrowed money, his real exposure had ballooned to somewhere around $100 billion, roughly 5 times his actual capital. And it was piled into just a few names. Most investors are taught to spread risk around. Hwang did the exact opposite. He concentrated everything, which multiplies your reward on the way up and your ruin on the way down. His buying was so large that it actually helped push those very stocks up. Viacom CBS more than tripled in just a few months. And the rising price made Hwang look like a genius, which let him borrow even more, which pushed the price higher still. A loop. As long as the stocks kept climbing, the machine fed itself. And ordinary investors were buying those same hot stocks too, riding a wave they had no idea was being inflated by one hidden man. Then in March 2021, the loop reversed. Viacom CBS announced it was selling new shares to raise money, a totally normal corporate move. But more shares meant each existing one was worth a little less. The stock dipped, and when you are leveraged 5-to-1, a dip is not a small problem. It is a margin call. The banks that had lent Hwang all that money called him up and said the value of your collateral just dropped. Put up more cash right now or we sell. Hwang did not have the cash, and that is the moment the banks discovered they were not the only ones he owed. What happened over the next 48 hours was a stampede. On March 25, 2021, the banks holding Hwang's positions realized the danger at roughly the same time. They held a call to discuss an orderly wind-down. It fell apart almost instantly, because every bank suddenly understood the same terrifying thing. Hwang could not cover his losses, and they were all holding the very same crowded positions. Whoever sold first would get the best price. Whoever sold last would be left holding the wreckage. So they ran for the exits. There was no coordination and no rescue, just a race. In a single afternoon, Some of the most sophisticated firms on earth were trampling each other to sell first. Goldman Sachs and Morgan Stanley moved fastest, dumping billions of dollars in stock before the price could collapse. Credit Suisse and Nomura hesitated, and they paid for it. Over 2 days, the bank sold off tens of billions of dollars of Hwang's positions into a falling market. Viacom CBS and Discovery were cut in half. More than $100 billion of market value simply evaporated. Archegos could not meet the calls. Bill Hwang's personal fortune, around $20 billion, was wiped out almost entirely in about 2 days. But the deepest question was never how he lost it. It was how he had hidden it for so long. Here is the trick, and it is the part that should worry you most, because all of it was perfectly legal. When you or I buy a stock, our name is on it. Buy enough of a single company, and the law requires you to disclose it publicly, so the market can see who holds the big positions. Hwang wanted to make giant bets without anyone seeing them at all, so he did not actually buy the stocks. He used something called a total return swap. Here is how that works, step by step. Instead of buying Viacom CBS himself, Hwang went to a bank and made a deal. The bank buys the shares and holds them in the bank's own name. Hwang puts up a slice of the cost as collateral, and the two of them sign a contract. If the stock goes up, the bank pays Hwang the gain. If it goes down, Hwang pays the bank. So economically, Hwang owns the bet. But legally, the bank owns the shares, which means Hwang's name appears nowhere, no public disclosure. The position is invisible. There's nothing to file because on paper, Hwang doesn't own a single share. The bank does. He just owns a private contract about where that share's price goes. Now the masterstroke. Hwang ran this exact same trade across 8 or 9 different banks at the same time. And here is the key. Each bank could only see its own slice of his trading. Not one of them saw the whole picture. So while every individual bank believed it was lending to a wealthy client with a sensible position, no single bank knew that Hwang had built the very same enormous leveraged bet everywhere at once. $100 billion tower spread thin enough that nobody ever felt its full weight. The leverage was hidden in plain sight, not locked in a vault, in the gaps between banks that did not talk to each other. And when the stock finally fell, every one of those invisible bets came due at the very same moment. The fallout was brutal, and it spread. Credit Suisse, a 200-year-old pillar of global banking, lost more than $5 billion on Archegos alone. A later report found the bank had brushed past its own risk manager's warnings for months, again, because the relationship was just too lucrative. It was one of a string of disasters that shattered confidence in the bank, and within 2 years, Credit Suisse collapsed entirely and was swallowed by its old rival, UBS. A single hidden client had helped bring down one of the most storied names in all of finance. If you banked there, had a mortgage there, or held its stock in a fund, a man you had never heard of was part of the reason it died. Nomura lost around $2 to $3 billion. Morgan Stanley and others took hits as well. All told, the banks lost roughly $10 billion for the privilege of collecting Bill Hwang's fees. Hwang was arrested in 2022 and charged with fraud and market manipulation. Prosecutors argued he had lied to the banks about the size and the nature of his positions to keep the borrowed money flowing. In 2024, a jury convicted him. He was sentenced to 18 years in prison. Archegos, the fund named for a prince, was gone. And the market learned, all over again, that a risk you cannot see is not a risk that isn't there. So what is the lesson here for anyone who isn't a billionaire trading on swaps? Because this one is really about the system your own money lives inside. 4 warning signs, and they reach far beyond Wall Street. 1. Invisible leverage is still leverage. Hwang's $100 billion position never showed up on a single public filing, but it was every bit as real as cash. Risk you cannot see on paper does not disappear. It just waits and surprises you later all at once. 2. A family office answers to no one. Hwang's fund dodged the disclosure that hedge funds face, and not by accident. That is what the structure is for. Whenever someone builds a vehicle specifically to escape oversight, ask what it is they do not want anyone to see. 3. And this is the warning sign I promised you at the start, the one every bank ignored. The past is a warning, not a footnote. Hwang had already been caught and banned once for the very same kind of conduct. The banks knew it. They chose the fees over the history. When someone shows you who they are, believe them the first time. Markets have short memories. Hwang's didn't even last a decade. 4. When everyone competes to lend, no one checks. This is the big one. Each bank wanted Hwang's business so badly that the one question that mattered, how much is he borrowing from everybody else, simply went unasked. The competition to win a client quietly became a competition not to scrutinize him. And the deepest lesson is the quiet one. The fortunes that blow up the loudest are almost always the ones nobody was allowed to look at. Transparency is not red tape. It is the smoke alarm, and Archegos tore it right off the wall. That's what we do here. Every week we take apart a scam. Once a month, the frauds that fooled entire markets. Subscribe, because the next hidden fortune is being built right now, and when it detonates, you'll already know exactly how it was done.